Hello, folks, and welcome to a Monday version of Weekly Commentary. So after a relatively quiet summer so far, investors suddenly have quite a bit to pay attention to. This week alone brings us NVIDIA earnings, another important inflation report, Federal Reserve's annual meeting in Jackson Hole, elevated interest rates, an escalated trade war now with Canada, and increasingly geopolitical uncertainty. Now, any of those could move markets, and this week we get to confront all of them. The major averages last week finished lower, with technology stocks again suffering the most volatility. Now, I'm not sure there was any one particular event responsible for that. Instead, investors continue to try to figure out how much to pay today for future growth, especially when interest rates have ticked up a bit. The 10-year Treasury is now yielding around 4.7%, while the 30-year is above 5%. Both have seen recent increases. These higher rates aren't putting nearly as much pressure on share prices today as they did in 2022, however. If you recall, during 2022, I was extremely frustrated over what I was claiming at the time were unwarranted declines in markets as investors feared the worst from those higher rates. Today's corporate earnings growth environment, I think, vindicates my argument back then that the economy and earnings could continue to flourish despite what were then and what are now historically normal interest rates. Fears, however, rise over concerns as to whether or not current rates can stay steady or possibly continue to climb. These concerns make this week's PCE number Wednesday morning, that's the Fed's preferred inflation index, and a potentially market-moving report. That report, along with NVIDIA's earnings later that day, Wednesday, will likely make Wednesday a key day for gauging the near-term direction of markets. Fed Chair Kevin Warsh will speak Friday at Jackson Hole in the media, and thus markets will undoubtedly spend the day analyzing every word for clues about the direction of interest rates. The media have done this with Fed speeches for many years, playing up one little adjective change, one rearranged sentence, and suddenly billions of dollars move around the world. It's a bit nuts, but because it is, those moves in either direction typically are short-lived. The bigger picture is fairly straightforward. If inflation remains stubbornly high, the Fed has less flexibility to lower interest rates, or worse, rates may rise. If inflation continues moving toward the 2% target rate, prospects for lower rates improve. Now, the situation in the Strait of Hormuz remains a big wild card in this equation because energy markets, inflation, interest rates, and thus the direction of markets hang in the balance. Oil prices remain elevated, with Brent crude trading in the low $90 range, and WTI crude in the high 80s. And as I've said before, however, there's a big difference between worrying what could happen and what actually does happen. Markets always give us reason, something to worry about. Wars, elections, recessions, inflation, interest rates, tariffs, deficits, banking problems, oil shocks, the list goes on. If we waited until the economic and geopolitical environment looked completely safe before investing, we'd never invest. So the most important question is whether those risks are actually changing the long-term earnings power of the companies we own. And then that brings us to NVIDIA. NVIDIA reports earnings Wednesday afternoon, and its results will probably receive as much or more attention as any economic report this week. NVIDIA continues to be something of a proxy for the entire artificial intelligence investment cycle and the entire market. That one company's earnings reports continue to move markets in meaningful ways. If anything, their influence has increased. And expectations are big. Investors are no longer just asking whether NVIDIA can sell more chips. We know demand for computing power is huge. The bigger questions now are how long that demand continues, how much additional capital needs to be invested, and what kind of return investors, customers, and others in this space are ultimately going to earn on the hundreds of billions of dollars being spent on AI infrastructure. During the first stage of this AI boom, simply announcing enormous capital expenditures, I should say, was often enough to excite investors. Microsoft, Amazon, Meta, Alphabet, and others could announce tens of billions of dollars in AI spending, and the market generally viewed that as evidence of tremendous future opportunity. Recently, however, we've moved from AI excitement to AI execution. Investors now want to see revenue and profits generated from those investments, which is a development I think should be viewed as a healthy sign for sustainable, longer-term growth. In other words, unlike the latter part of the 90s, excitement alone hasn't propelled most of today's players toward the unsustainable share prices we saw in that previous era. Now, I continue to be optimistic about artificial intelligence over the long term. AI should improve productivity, reduce costs, create new products, and change how many business operates, as well as add new jobs. That is, if politics doesn't get in the way, but that's for another commentary. In the meantime, economic growth remains resilient, corporate earnings remain strong, technology continues to create significant productivity opportunities. At the same time, inflation remains higher than the Federal Reserve would like. Long-term interest rates are elevated and ticking upward a bit, and geopolitical risks are real, and valuations in certain part of the market, while not near crazy unsustainable levels, they do leave less room for disappointment in the earnings reports. That combination, this tug of war between optimism and concerns, will probably continue producing volatility. But folks, volatility and bear markets are not the same thing. Corrections are a normal part of investing, even during very good long-term markets. Headlines change from week to week, but it isn't headlines that determine the long-term direction of markets. There's always going to be something for investors to worry about. This week happens to be a bit more than usual, and we will, as always, remain focused on the longer-term fundamentals. And at the moment, those fundamentals remain encouraging. So until next time, have a wonderful week.